studying the international financial system. We've done with the research team in Groningen, done a lot of work over the last years in building up a data set on the issue that Josh was talking about, a shift in the use of bank lending away from non-financial business funding towards household mortgages mostly, but also financial assets financing, and the consequences for the macroeconomy. So I'm interested in the consequences of financial system functioning, forms ownership on macroeconomic outcomes, including growth, instability, distribution of income. So we've got papers forthcoming and papers published on these topics based on a newly collected data set that we put together on 70 economies, where we trace this distribution of credit over time and study the consequences with fairly standard econometric techniques. So I think I would be what I would like to see come out of this is the next question, the question that naturally follows up on this, and that's first, how can we better explain this shift, which is still ongoing? We are not deleveraging, and there's no shift back towards a reconnecting of the financial sector and the real economy. If you want to make that distinction, very problematic. But that hasn't happened since the crisis, according to a number of indicators. So to understand, and this doesn't fit with traditional credit cycle theories, which tell you that there will be deleveraging after a crisis. We're still living in a high debt economy. Why is that? So, and I think going beyond the econometrics of that, so we need to better understand what the institutional and the policy lobby constellation around this is. So political economy, sociology is going to be helpful in understanding better why this is, because I see the same in my country, in the Netherlands. It's not as extreme as in Slovenia, but there's clearly a pushback towards regulation from bankers and for instance, lobbying for higher loan-to-value or loan-to-income ratios and so on. All the signs are there of refinancialization. So we need to understand this from a social sciences perspective. The second thing, and I'll say more about this here, is resilience. Let me just say more about it in the presentation. So I'm supervising PhD thesis work on the legitimacy of central banks, on the relation between agent-based model of the relation between housing market and macroeconomy, on measuring the financial cycle. So I'm doing a diversity of work in this area. Now do I have half an hour, a bit more, yes. 40 minutes maybe? So let me, just stop me if it's too long, but it shouldn't be. So I'm really delighted that, straight from the start we were talking about very specific policy choices and institutions, and I didn't know that beforehand when I made this, so I'm coming in at a very general level because I needed to start thinking about resilience basically from scratch. So apologies for that. So resilience, one dictionary definition mentions the remarkable resilience of so many British institutions. Yeah. So this is a good place to talk about resilience, probably.
One exception.
Yeah, maybe a few. This is a definition from Volker Grimm, is a German ecologist who has done a lot of work on resilience. This is from a paper by him in 2011. So resilience, one definition is, can a system return to a reference state or dynamics after temporary disturbance? Elasticity is also often used interchangeably with resilience, the speed of return. So not does it return, but the speed of return to the reference state. That's what system thinkers typically think about as resilience. But there's a huge issue around defining resilience. In a more practical matter for economists, right, this Charles Dickens character, if your expenditures rise a little bit, and that makes the difference between happiness and misery, then you're not resilient, right? This is why resilience matters. This is micro financial resilience. When I did quite a broad literature study in preparation of this. Most financial resilience studies are about micro, about poverty, about Can households withstand shocks when they lose their job or when they go through a divorce or something? That's important, but that's not what I will be talking about. I will be talking about macro financial resilience. Does the economic system, how does the economic system respond to shocks? So I'm not interested in the resilience of the financial system per se. It's about the financial structure of the economy rather. So I'll talk about why we would want to research this, why I would advocate that this finance hub, starts research on resilience. Definitions, what is a conceptual framework in economics? Is it there at all that we could use to start thinking about resilience? The research that I did find, and I just give some examples, of course, I will do huge injustice to a lot of people here. I will categorize it into 5 research approaches, including you, Panikos, and your financial fragility work. But there will be room to talk about that. Some tentative conclusions and suggestions for questions that we should ask to guide research directions. So why should we research this? Well, just a bit of more general background. It's really striking that resilience is hot. This is discussions in society, not just in science, not just in economics. This is Google Trends. So this peaked in October 2017, a year ago. So mentions of resilience in Google Trends have been trending upward all the time. So resilience is in the air, you might say. Also in science. So there's now over 50,000, last time I looked it was this, now it must be more than 50,000 publications listed in Web of Science under the topic of resilience. And by far most of them are in environmental sciences, ecology, and so on. Not so much in economics. There's more than 20 disciplines that publish more on resilience than economics, right? So only about 2% of those 50,000 publications since 2000 are in economics. But there is a rise in publications. Those 940 publications, there's a rise in the amount of them per year since 2000. So there's growing interest in economics as well, but it's tiny compared to other disciplines. That may be because it's a topic that simply is nothing to do with economics, or it may be that economists are missing something, and we have a very nice opportunity to fill a gap here. No prizes given here. Within economics, so this is the 940 publications, that is 2% of everything on resilience. Again, most of those publications are about environmental studies, environmental sciences, geography, planning, transport, so to do with the physical environment, right? There isn't a lot, there's actually very little on financial resilience. So here's business. But that is very, very, very small. So why research it, right? We're clearly ahead of the curve if we do that. To my mind, it's sort of the natural big leading question to ask. So we've had this finance growth literature, right? Which ended with this famous paper by Arkan and others, too much finance. Oh, yeah. So is finance good for growth? The consensus was yes, financial development is good for economic development. Lots of studies on the causality, but yes. Then in 2012, this paper, Too Much Finance, came out. Now, the consensus is there's maybe too much finance, but I agree actually that the huge finding, which is a huge finding if it's true. I think there's a lot of qualifications there. It has simply gone away. I mean, certainly people in the biz have kept on to it, but they were always critical of credit growth. But you don't see papers like that again published in the AER or the Journal of Economic Growth or really top journals. So it's gone away. It's gone away, and that's really interesting. So after the crisis, the next big leading research question was: does financial development lead to a crisis, and when does it? And so there's all this research, and I think now we're ready to ask the questions: how do we maintain growth after the crisis, or how do we maintain economic systems at all in an equitable or sustainable manner? If you're a zero growth person, you can go that route. So living with resilience means being aware that you don't want the bubble and the bust, but you also don't want low growth and decline. You want to be in between that. You don't want instability that leads to a huge crisis, but also you don't want the stability that is stagnation, right? And resilience is what a system needs to have to avoid that. Okay, so we are sort of zooming in, trying to define this. And a more practical reason why we should look at resilience is that resilience becomes important after a shock. And the IMF, for one, thinks that some shocks are ahead, a bumpy road ahead. This is the April Global Financial Stability Report, where Tobias Adrian writes that a variety of indicators point to vulnerability from financial leverage, which is still high and rising. That's to do with leverage lending. So there on the left hand, higher score equals weaker lending loan qualities. And on the right hand, these are two graphs from the same report. And on the right hand side, weaker credit quality issuers are accessing the markets since about 2 or 3 years probably. This is really going up. So we see not deleveraging, and then since 2014, renewed growth of global debt relative to income, and now since the last 2 years probably a worsening of the debt quality. So all the signs of coming to the end of a financial cycle are there. The more so since, let me just go back to that in a minute, the more so since the financial cycle, right, this is the famous work also by BIS people, Matthias Dreeman and others. The financial cycle has become bigger since the 80s, but also longer. And we are now, I think the US is in its longest expansion since the expansion that started in 1992, if they go on a bit more. That's very long, but then probably the shock that comes after such a long expansion is also going to be bigger in the nature of things. And while the real economy is stable and we have high growth, relatively high GDP growth and stability, the financial markets are no longer stable since certainly this year volatility is back. This is from April, the Wall Street Journal, the fear gauge, the VIX is up. So there's a lot of different signs by international institutions, by financial markets, that we are in for a bumpy road. The shocks are coming that we haven't had for a while, and then it matters how the economic system responds to that, and that is determined by how resilient the system is. Okay, this is already quite a lot in terms of defining resilience. There's this study by Briguglio and others, which makes the useful distinction between vulnerability and resilience. So vulnerability, if I translate it, is the probability of a crisis. These is the dictionary definitions here between brackets. I would translate vulnerability as the probability of a crisis, and resilience is the expected damage given a crisis. Okay, so it's not so much can we avoid the crisis, but what will happen if a crisis happens. That's why it's a complex concept, because it's a conditional concept. It's about financial structures now and how they will work out after something that isn't the case now. That's difficult. It's conditional probability in statistical terms. And as far as I know, we don't have a theory of financial resilience, but we do have a theory of financial fragility. And I think to my mind, it's most fruitful to think of resilience as the opposite, not of vulnerability, but of fragility. So it's the shit after the shock, right? It's the damage after a crisis. That's financial fragility. So it's not anti-fragility, right? Nassim Taleb wrote about anti-fragility means if a system is anti-fragile, it becomes better after shocks. That's what this book is about. That's a wonderful idea, but that's not what I'm talking about. But Hyman Minsky, of course, developed a theory of financial fragility or financial instability, which is something different. So I think that's a framework that we can build on. I mean, even though there's hardly any research on resilience, if we look at the keyword in the Web of Science, there is something in economics that we can build on. And I think the most helpful framework is Minsky's framework as a starting point, not as an end point. And Minsky's motivation to look at financial fragility. So now I'm going to talk about financial fragility, which is the opposite of resilience. So once we understand how financial fragility builds, we probably understand how we can avoid that and build resilience, right? That's my approach. And Minsky's motivation for developing a theory of financial fragility was that capitalist economic systems market economies with sophisticated financial markets, that was his object of study, can be in a state of Great Depression. That, of course, what he experienced was what motivated him. The 1929 crash, the 1930s Great Recession. So if we have a theory of the economic system that does not allow for this state, we don't have a good theory. That was his starting point. So he is much closer to the ecological resilience concept there than to an engineering resilience concept. And the engineering resilience concept is close to the equilibrium concept in economics. There is an equilibrium. The question is, how fast do you get back to it? But there's only one state, and you get back to, that's the equilibrium. And the ecological concept is the economy can be in different states, not just different equilibria, but qualitatively different states. And once it crosses a threshold, it will get stuck in a new state. And how do we understand that dynamic? That's the ecological way of thinking. And so Minsky is close to the ecological way of thinking. So I think we can use Minsky's framework also as a bridge to source 40 years of research in ecology on resilience. I'm going to say a bit more on that. Other thinkers, or other, at least writers on financial fragility, have come up with definitions. The degree to which small shocks have disproportionately large effects, like Mr. Mike Colbert from David Copperfield, who, you know, they're all sort of there, but I think we need to be more precise. I think the question to ask is about financial macro resilience. What are the financing structures that cause shocks to translate into debt deflation? The shocks will come anyway. We're not out there to prevent shocks, right? But we do want to prevent debt deflations, which are extremely harmful to the economy. So mass unemployment, mass bankruptcies, and so on. And whether or not that will happen depends on financing structures. Now, here it gets difficult because there are endogenous shocks, so financing structures themselves generate instability, and that needs no explanation here, I'm sure. But then the financing structures also impact, play a role in the case of exogenous shocks. So whether or not a shock leads to financial problems depends on financing structures. And by financing structures, I mean something very similar to Hyman Minsky's financing profiles. It's the way that growth is financed. How much debt is there, how much equity, is there much mortgage debt, much business debt? Those are financing structures. And they determine also whether financial problems lead to financial instabilities. It doesn't have to be. And whether financial instability crosses over from the financial system to the real economy and leads to debt deflation processes. All that is, you know, and we've seen, I think in 2010 there was a special issue of economic policy which brought together studies saying, well, what explains the length and the depth and the severity of post-crisis recessions in developed economies after the crisis? And there's a huge variation in the length of recessions, the depth of GDP growth loss, for instance, and a lot of that can be explained by financing structures, both international and domestic. Okay, so if we take Minsky's framework as a starting point, financial fragility is a decrease in the ability to meet payment obligations after shock to a unit's financing conditions. It could be a firm or a household or a country or a sector or a bank. And the financial instability hypothesis connects decisions to invest, which lead to future revenues, to the means of financing the investment, which lead to future obligations. So you set up streams of future revenues, cash flow, and future financial obligations. And financial fragility emerges when those two are not matched. Not in time, maybe, not in denomination. That is a financial fragility problem, if I put them in Minsky's terms. And so Minsky came up with these three financing profiles, I call them, which is the extent to which units like firms can meet their payment obligations arising from financing obligations. Hedge positions is when you can always, at any point in time, match principal and interest, which is rare, maybe less rare now than in Minsky's time. So there's no need for lending there. You can meet all from your own resources. Speculative positions is what a normal developing economy, I mean a normal growing economy, which is qualitatively also changing, whether highly developed or emerging. A normal economy has a lot of speculative positions, so it's the speculation is that you can roll over your debt, that you can refinance, which is not dangerously speculative at all if you have a normal financial system, right? So this is the normal state of an economy that is innovating and growing. And then Ponzi positions are positions where units cannot even pay the interest, let alone the principal, and so loan obligations need to be met by new loans. And Ponzi schemes are by definition unsustainable, so you're in for a shock here and probably a crisis. So it's past lending that must commitments from past lending that must be matched to current incomes, right? This is where the dynamic nature of financial fragility is. Let me give an example. This is the credit cycle in Spain. So here you see that the cost of mortgage liabilities, this is household mortgage debt in money terms, is rising faster from here on, faster than total incomes. GDP is total income. So on the macro level, this is where problems start. If you apply Minsky's concept in a very simplistic way, because you want to look whose incomes and whose debt obligations, but only here, of course, the shit hits the fan. So this is where mortgage-related liabilities can no longer be met, either by households or they may be derivatives from mortgages, which can no longer be met by banks or investors. Okay, here you see the problem of empirically analyzing financial fragility, because here you could put up your finger and say we are on a path of increasing financial fragility, but it will take 8 years before that leads to a crisis, which is caused by an exogenous shock, by the American credit crisis, Euro crisis, not the Euro crisis, but which caused problems for Spain because of an exogenous event which impacted on Spain given its own financing structures, right? So that's an example. So more detailed balance sheet analysis of where the liabilities and where the assets, where the revenue, income streams, the cash flow streams are, more detailed analysis is needed to do that. And this is just one example of financing structures that may undermine resilience and cause fragility. In this OECD study on resilience indicators, they give a number of financing structures in different markets and sectors, which all create what they call vulnerabilities, what I would call financial fragility. So this is just to lay out the complexity, and doing research is, in part, is reflecting complexity that we need to understand, but also reducing complexity. We need models, of course, that are as simple as possible, but not simpler. And the challenge here is how to do that, because we've had models which were far too simple, which neglected the finance side of macroeconomics, but we don't want to get into something that we don't understand anymore. Okay, and I think some of the research is going there, and so how do we deal with this? And that's where I'm going now. I'm going to tell you about the research on financial fragility that I found, and I apologize beforehand. I probably missed a lot. So it's always about how to research the impact of financing structures on macroeconomic outcomes given a shock. That's a general question that all this research addresses. And some challenges is how you detect vulnerability before the shock happens. We'll see some examples of operationalizations which don't do that. How to observe damage resulting from vulnerability. Should we look at the rate spreads, which is a purely financial indicator? Why should we care about that? Should we look at the credit crunch? Should we look at GDP growth? Should we look at unemployment? And you get very different answers to how resilient your system is depending on the outcome. All instability and every recession is characterized by financial distress. But how do we know that it results from financial distress? This is a very hard question. You look at the data. It's a very simple question, but very hard. and how to distinguish between financial instability and financial fragility. I think conceptually that's clean cut. You can make the distinction clearly. But again, in empirical research, this gets difficult. These are 5 approaches, which I will now discuss. Okay, the first approach is to basically look at the start and the end of this. Start and the end. And say, well, in case of a shock, let me observe financing structures and changes in financing structures before the shock. Let me observe the outcome, which may be growth loss. And let me see what is the change in the damage post-shock conditional on the changes in financing structures pre-shock. Most of the studies that I mentioned in economic policy are doing something like this. And we also have a study out now in the Journal of Financial Stability that does this. And I should just show you 2 pictures of that. Right, so this is a regression approach. You correlate the change in post-crisis growth, the loss of it, to the change in pre-crisis financing structures. And in my own research, I've specified financing structures as the allocation of bank debt, what I was talking about earlier. So for the Netherlands, you can very clearly see that debt relative, this is total private bank debt relative to GDP, which has been rising almost exclusively due to the rise in home mortgages. Not in euro terms, but in relative to GDP. And there's theoretical reasons why that should be the case. So if you look at payment obligations arising from liabilities relative to income, GDP is the sum of all incomes, this is what builds financial fragility, right? That's what Minsky's framework would lead you to expect. And if we, yeah, sorry.
Just a follow-up. I mean, isn't there also an issue of the changing income distribution?
Can you speak up?
There is a changing income distribution in the period of time that you're looking at.
Yeah.
Actually aggravates your effects. And so, are you looking at that?
Yeah. So we have one paper out, and I'm now looking at a change in income distribution during a boom and a bust. So, yeah. That's another macroeconomic outcome that is so important. 5 minutes. So if you correlate the share of mortgages in all credit for, this is for 50 countries, the share of mortgages in all credit, in all bank credit, and this is the depth of a recession. That's the peak to trough GDP loss after 2008. You see this positive correlation, and you can make some claim to causation there because it's before and after, and we also do this. Well, we apply some techniques that not only GMM, but that support the causal claim there. So that's one way to do it. Another study that takes the same approach is by David Eichmann and others, which look at correlations to contraction. So which variables correlate to post-crisis contraction? If these variables, and I don't know what the runables are here, if these variables go up in value, historically that's correlated to post-crisis contractions. Yeah? So it's again linking financing structures, which are measured, observed by these ratios or these variables, linking that to real economic outcomes. Okay, and so the lesson would be if you observe these variables, you can say something about future contractions. A second approach, I will speed up a little bit, is to say that's too general. This was very much a reduced form approach. You should look at balance sheets. This is Eric Timoin's work looking at U.S. sector balance sheets. This picture is awful, I'm sorry. And he creates an index of financial fragility. I'm not aware of work that shows how good it is, but it takes some a priori plausible things like refinancing volumes. The more you need to refinance, the more vulnerable you are, and the debt service ratio. The IMF has started in 2002 already, after the Asian crisis. They started a stream of work on a balance sheet approach to financial crisis. Very, very detailed work, and I've read these papers. Again, I'm not aware of analysis of how good it is. It's used for policy analysis and interventions, but I'm not aware of how good it actually is in foreseeing fragility. The third approach is to build an index. This is the IMF Financial Stress Index. Strictly speaking, shouldn't be in here because stress isn't fragility. These are the things that go into the index. So it's a financial market stress index. And the problem with it is that it peaks during the crisis, but at a time when fragility was building up, it's very low. So when all market participants are very optimistic and relaxed, there's no stress. No stress doesn't mean no fragility, right? So I shouldn't be showing it really, but these two things are often conflated just to show that they really aren't the same. Another index is by the ECD stream of work on resilience that they did in the last few years. And they show things like strong private credit growth is a robust predictor of banking crisis, and also current account deficits and real estate market downturns. So they don't, in my book, in my definition, they don't look at fragility, but they look at vulnerability. Predictor of crisis means, are you vulnerable? Is it likely that you're going to experience a crisis? That doesn't mean you're not resilient. Like Iceland experienced an enormous crisis and recovered very quickly. So very vulnerable and very resilient, right? If you're resilient, doesn't mean you're not vulnerable. So here's the work that Panikos and others did on a database on financial fragility. These are the variables that go in their financial fragility index. I've looked, but I haven't found work evaluating how good it is in terms of predicting, but I may be missing some work that you're going to share with us. It's the same principle, looking at financial market variables to do this. The fourth approach is to take a real systems perspective and to replicate and simulate the whole system. This is work by Campilio, Godin, and Benedict on so-called stranded assets. Okay, there's a story behind that, but the thing is that you try to really build in your model, replicate the components of the real economy and the components of the financial sector and how they interact, and then simulate, and then run the system. So this is how they show it conceptually, and this is what they model explicitly. This is a stock flow consistent model. This is what they model explicitly. You specify the relations between those sectors, and then you run the model. Here, to my mind, you're much more realistic, but also it's much harder to know if you have a different simulation outcome due to one change. It's much harder to trace that to whatever mechanism you have. So it's more difficult to know the mechanism here, while the whole model is set up to model explicitly the mechanism, which we didn't do before. So this is one of, I think, the most promising work, but also deeply problematic from a scientific point of view. How do you attribute effect to cause? I'm having discussions on that with Antoine. And finally, this is work done by the New Economic Foundation a couple of years ago. That's scenario analysis, and it's surprisingly little scenario analysis in economics that I found. So it's based on 7 resilience indicators like diversity, interconnectedness, asset compositions, scenarios, policy proposals, and scoring them qualitatively. And so, well, what do they do to resilience indicators? That gives you maybe a very practical feel for what's likely to happen. Conclusions. Post-crisis, macrofinancial resilience has to be relevant, much more relevant than is reflected in the amount of research that we find. So there's a huge opportunity there. There's no clear theory of financial resilience, but there is a theory of financial fragility. Good point to start. I also wanted to, but fortunately for Ekaterina, I dropped the idea of also talking about ecological research, which I think is It really has a lot of lessons for us. But that I simply can't work that in, of course. But I think what we should do, we economists should do, is maybe in this hub, is to get together with ecologists and sociologists and learn those lessons, right? So this is the Resilience Alliance, 40 years of resilience research and thinking, practitioners and academics. We can talk more about this in the rest of the morning. And these are, to conclude really, the last slide, these are some of the research questions that I think we should ask ourselves when we want to think about resilience. Okay, thank you for your patience and your interest. Thank you.